The Federal Reserve is reportedly rethinking some of its rules when it comes to mid-sized banks following the collapse of SVB. The Fed weighing tougher capital and liquidity requirements for banks that hold assets between $100 billion to $250 billion. And Julie, we were talking about this yesterday and probably the day before as well. But I think this gets back to we're always fighting the last crisis, and the regulators are fighting the last crisis. You know, thinking about the GFC where we had credit risk, people didn't trust each other because they were doing potentially some shady things. Well, now we have all kinds of new problems here. We have interest rate volatility that we haven't seen since the early 80s. And so this is a different paradigm. And yes, it's not surprising that when we got all these, Dodd-Frank probably went too far, that pendulum, kind of swinging out that way. Now that it's come back, it's been revealed that, we were addressing the wrong thing. So is this a surprise? I don't think so. But it takes years to form these regulations and years for regulators to wrap their heads around it. What matters in the moment is what the Federal Reserve and what authorities do on an emergency basis. And once again, they have extended the lifeline and said we are going to save the depositors and the uninsured depositors, which was somewhat unexpected. Potentially a very good thing not potentially, it is a very good thing for all those uninsured depositors. But then on the flip side, that introduces moral hazard. And then the regulators and Congress have to figure this out for years, what they're going to do. And then there's another crisis.
And there's another crisis, maybe in a totally different spot.
I would think so.
Right. I mean, that is the concern here. Nonetheless, as we've talked about a lot with different guests in the past few days, many of them have pointed to the idea that these mid-sized banks were not subject to the same type of stress tests that the Federal Reserve does for the largest banks. And so in theory, it makes sense. Those mid-sized banks, including very specifically Silicon Valley Bank, had lobbied against having to abide by those more stringent regulations, arguing that it was too onerous for banks of that size. So all of this, as you say, makes sense in theory. Will it prevent the next crisis? Who knows,
but
right?
At the end of the day, we have the Fed put. And I think if you're making a calculation, the folks at SVB who were neglecting their duties to hedge their interest rate structure, were they thinking in the back of their heads, okay, if this thing goes south, well, we got the Fed at our backs.
I don't know that people think in that explicit way, right? I think people just think nothing's going to go wrong. Or they ignore their voices in the head.
And incredible inertia. I mean, we're talking about things that took years and years to develop, and then we only find out about them in a few days. So there's that too.
And then on the flip side, the larger banks are getting larger as a result of all of this.
Yes, very important.
There's a report from Bloomberg that Bank of America alone has gotten $15 billion in new deposits after SVB collapsed. They're citing people familiar with the situation. And that's not surprising. That's something we talked about and theorized about, right? Because all these people who were no longer banking with SVB, that $200 billion in assets has got to go somewhere, right? Or the deposits, I should say, have to go somewhere. And so it's not surprising that they would be going to those kinds of areas. But then more risk then resides.
Yes, and we have too big or too fail. And you take a look at the net result here. The Federal Reserve with this new lending facility, which basically guarantees billions of dollars of deposits, that only facilitates the transfer of deposits from regional banks to the bigger banks, which is happening right now. It's not just the failed banks that people are withdrawing funds from. It is the non-failing banks as well. So go ahead.
I was just going to say we've got a lot of people who have been weighing in all this in the past few days. The latest person I saw was Larry Fink of BlackRock, who came out with his annual letter to investors. And he said, we don't know yet whether the consequences of easy money and regulatory changes will cascade through the U.S. regional banking sector, akin to the S&L crisis, that's the savings and loan crisis, with more seizures and shutdowns coming. And this is also a question we've been discussing a lot of the past few days. What's next?
Yeah, well,
and we don't have the answer to that
rest
yet.
with the Fed, what they do next week too.
Yeah, and we've seen a resumption in declines for many of those regional banks that had bounced yesterday.
Yes.
So we shall see.